Hey guys, Steve Polisi here. Tax deductions are a key part of any property investment strategy, and depreciation is one of the most valuable deductions available to Aussie investors. Basically, depreciation is a non-cash deduction for the wear and tear of a property over time. This includes the wear and tear of fixtures, fittings, and the building itself. By maximising your depreciation deductions, you can significantly reduce your taxable income and boost your cash flow. This can make a massive difference to your bottom line. And so regardless of whether you're a cash flow positive investor or a negatively geared investor waiting for capital growth, there are a ton of benefits to claiming depreciation. And today's video is all about sharing that with you, so stick around. Let's jump straight into how depreciation works. Depreciation is claimable under two types of ATO allowances: Division 43 capital works and Division 40 plant and equipment. Capital works are the items that make up the building and those that are fixed to the building. These would be things like bricks and mortar that make up the building, retaining walls, built-in wardrobes in residential buildings, or built-in workstations in commercial properties. Your capital works deduction is dependent on two things: when it was built and the type of building you own. For example, a residential building purchased after the 16th of September 1987 will depreciate at a rate of 2.5% each year for the next 40 years from the date of construction. The same rate applies to offices, warehouse, and other commercial buildings. Plant and equipment items are one that can be easily detached from the property and generally wear out a lot faster when compared to the bricks and mortar of your building. This often means they generally offer accelerated levels of depreciation in the first couple of years. Examples of typical plant and equipment items include carpet, blinds, kitchen appliances, light shades, security systems, elevators, air conditioners, hot water systems, just to name a few. Each item has its own tax depreciation rate based on the ATO's asset effective life schedule, which gives guidance as to how many years the ATO feels the asset may wear out. A packaged air conditioning unit, for instance, has an effective life of 15 years, while a coffee machine has an effective life of 5 years. Timeline is also an important factor here, because unless your property is brand new, if you purchase your property after the 9th of May 2017, you won't be eligible to claim depreciation on plant and equipment assets. One of the great things about depreciation is that unlike other expenses you claim, where you pay for something and then claim it back on your tax return, depreciation is a written down or calculated deduction. This means you just use the figure reported in your depreciation schedule each year and include it as an expense on your tax return. Which brings me to my next point about depreciation. To claim your property's depreciation deductions, you'll have to identify the value of the property and all its fittings and fixtures. The only people qualified to do that are quantity surveyors. Once they've evaluated the value of your Division 40 and Division 43 assets, they'll compile a depreciation schedule that'll allow you to claim your deductions. One more thing I'll mention about depreciation before we look at how it can improve cash flow is that with commercial properties, property owners and tenants can claim deductions. Commercial property owners can claim depreciation deductions for the building structure as well as any assets they own within their property. Commercial tenants, on the other hand, can claim depreciation deductions for any assets they purchase and install during the fit out. This includes construction costs of any renovations made to the building. All right, so how does depreciation improve your cash flow? Understanding the impact of depreciation on cash flow is particularly useful when assessing the after-tax cash flow of an investment property. Investors need to know how it's going to affect their back pocket every week. Let's look at an example where an investor didn't claim depreciation. They were essentially in a negative cash flow position of around $45 per week or $2,348 per year. This means the investor has to find roughly $180 per month to make up the shortfall between the income generated by the investment property and the expenses incurred. After consulting a quantity surveyor, the investor realized that they could claim a deduction of $10,100 for the year. After doing all the necessary calculations, the post-tax cash flow of the property became around $27 per week, or $1,389 per year positive. This means the investor was pocketing an extra $72 every week instead of paying money out of their own pocket each month. In a practical sense, the depreciation deduction would simply reduce your taxable income for the year, which means you wouldn't necessarily be getting a tax refund, you're just paying less tax. But if you look at the overall funds saved for this investor, there was over $3,000 difference between claiming depreciation and not claiming depreciation. The investor could either use that to pay down their debt or reinvest it back into growing their portfolio. It is worth noting though that your property is physically depreciating, so it's worth budgeting for renovating the property. So, if you're not claiming depreciation on your investment property, you're most likely overpaying your tax by thousands of dollars each year. I'd highly recommend you reach out to a quantity surveyor to chat about how much you could be saving. Anyway, folks, I hope you found this video useful. If you did, make sure to like and subscribe for more commercial and residential property investment tips and tricks. I'm Steve Polisi, author of Residential and Commercial Property Investing Explained Simply. Cheers.